Welcome to HouseLux Estate, your go-to channel for all things property investment. From the sun-drenched coastlines to the bustling city skylines, we're here to guide you through the labyrinth of the property market, making it accessible to everyone, regardless of your budget. We believe that everyone should have the opportunity to invest, and we're here to show you how. At HouseLux Estate, we delve into the nitty-gritty of property investment, demystifying complex market trends and breaking down jargon into everyday language. Whether you're a seasoned investor looking to expand your portfolio or a greenhorn stepping into the investment world for the first time, we've got you covered. Our content is tailored to equip you with the knowledge and confidence to navigate the property market. We offer insights, strategies, and tips to help you make the most out of your investments. So, buckle up and get ready to embark on this exciting journey with us. Stay tuned to learn how to start investing with as little as possible. Investing might sound intimidating, but it's simply putting your money to work for you. So, what does it mean to put your money to work? Well, it's all about making your money grow or appreciate over time. It's about using your funds in a way that they generate more wealth for you in the future. Investing is a crucial part of building wealth. Why, you ask? Because it offers a way to potentially outpace inflation, increasing purchasing power over time. When you invest, you're not just saving your money, you're making it work for you. You're giving it the potential to grow, to multiply, to create more wealth for you. Now let's talk about the different types of investments. These are often referred to as investment vehicles, and just like real vehicles, they each offer a different ride. First, we have stocks. When you buy a stock, you're buying a piece of a company. You're becoming a part owner. If the company does well, your stock can increase in value. But remember, if the company doesn't do well, the value of your stock can decrease. Then there are bonds. Bonds are essentially loans you give to a company or the government. In return, they promise to pay you back with interest after a certain period. Mutual funds are another option. These are essentially baskets of stocks or bonds. When you buy a mutual fund, you're buying a piece of each investment within that fund. It's a great way to diversify or spread out your risk, which we'll talk about more in a later scene. And let's not forget real estate. Buying property can be a solid investment. It can provide rental income, and in many cases, the property itself can appreciate in value over time. There are more types of investments out there, of course, but these are the basics. Each one has its own risks and rewards, and it's important to understand these before diving in. Remember, the goal of investing is to put your money to work in one or more types of investment vehicles in the hopes of growing your money over time. You might be wondering, but I don't have a lot of money. That's okay. You can start small. It's a common misconception that you need a hefty bank account to start investing. In fact, the opposite is true. You can begin your investment journey with just a little bit of money. And here's how. Firstly, it's essential to understand the power of saving and budgeting. You see, every dollar saved is a dollar that can be invested. So start by reviewing your income and expenses. Look for areas where you can cut back, no matter how small. It could be as simple as skipping that daily coffee run or cooking at home instead of ordering takeout. These small savings can add up over time, providing you with a tidy sum to start investing. Next, let's talk about compound interest. This is the secret sauce that makes your small investments grow over time. Compound interest is essentially interest on interest. It's the snowball effect at work in the world of finance. With each passing year, you earn interest not only on your original investment, but also on the interest that investment has already earned. Here's a simple example. Let's say you invest $100 at an annual interest rate of 5%. After the first year, you'll have $105. But the magic happens in the following years. In the second year, you'll earn interest on $105, not just your original $100. And this process continues year after year. Your investment, no matter how small, grows exponentially over time, so don't be discouraged if you're only able to invest a small amount at first. Remember, the key is to start, no matter how small, and let compound interest do its magic. And as you continue to save and budget, you'll be able to invest more and more. So don't worry if you're starting small. Every big investor started somewhere. Now that you've saved some money, it's time to choose the right investment. So how do you go about this? Well, the first thing to consider is your risk tolerance. This is simply your ability and willingness to lose some or all of your original investment in exchange for greater potential returns. Are you a risk taker? Ready to brave the stormy seas of the stock market? Or are you more comfortable with the steady, slow-growing safety of a bond? Understanding your risk tolerance can help guide you towards the type of investments that suit you best. Next, think about your time horizon. This is the estimated number of months, years, or decades you'll be investing to achieve a particular financial goal. If you're saving for a down payment on a house you plan to buy in 5 years, you might choose different investments than if you're saving for retirement 30 years away. The longer your time horizon, the more risk you might be able to take on because you have more time to recover from any potential losses. Lastly, consider your financial goals. Are you investing for retirement? Saving for your child's education? Planning a dream vacation? The end goal can greatly influence your choice of investment. For instance, if you're saving for a short-term goal, you might lean towards more conservative investments. But if you're investing for a long-term goal like retirement, you might opt for more aggressive investments that have the potential for higher returns over time. Remember, no single investment is right for everyone. Each person's situation is unique. So it's important to consider your individual circumstances and not just follow the crowd. And don't forget, it's perfectly okay to seek professional advice. Financial advisors can provide valuable insight and help you make informed decisions about your investment choices. Choosing the right investment is crucial to your success as an investor. So take your time, do your homework, and make sure your investment choices align with your risk tolerance, time horizon, and financial goals. Happy investing! Once you've chosen your investment, it's time to diversify. Diversification, in the simplest of terms, is about not putting all your eggs in one basket. It's a strategy that reduces risk by allocating investments across various financial instruments, industries, and other categories. It aims to maximize return by investing in different areas that would each react differently to the same event. Think of it this way. If you only invested in a single company's stock and that company went under, you'd lose everything. But if you had your money spread across several different companies, in different industries, even in different countries, then the impact of any one company failing would be much less severe. Diversification isn't just about spreading your investments across different companies. It's also about diversifying across different types of investments, also known as asset classes. These include stocks, bonds, real estate, commodities, and even cash. Each asset class reacts differently to market conditions, and having a mix of them can help smooth out the risks. For instance, when the stock market is down, bonds might be up. When real estate is slow, commodities might be booming. By having a foot in each market, you're better equipped to weather the storm of market fluctuations. Geographical diversification is another important aspect to consider. Different countries and regions around the world have different economies, and they're affected differently by various global events. By investing in different regions, you can protect yourself against the risk associated with any one area. But remember, while diversification can help spread risk, it's not a guarantee against loss. It's a strategy to help you reach your long-term financial goals, and it's not a one-time task. It requires regular review and adjustment as market conditions change. So as you embark on your investment journey, remember to spread your investments across different asset classes, industries, and regions. This way, you're not just betting on one horse, but on the entire race. Remember, diversification is key to managing risk and maximizing returns. Let's quickly recap what we've learned today. We began by understanding what investing really is, a method for growing your wealth over time. We explored the idea that you don't need a fortune to start investing. In fact, starting small can be a smart and practical approach. We then delved into the crucial step of choosing the right investment. It's not about chasing quick profits, but rather identifying opportunities that align with your financial goals and risk tolerance. Remember, every investment carries some degree of risk, but thorough research and planning can help mitigate these risks. Next, we talked about the importance of diversifying your investments. By spreading your money across different types of investments, you can buffer against market volatility and increase the potential for returns. Remember, investing is a journey, not a destination. Start small, choose wisely, and diversify. And most importantly, stay informed and keep learning. Don't forget to subscribe to House Lux Estate for more investing tips and insights.